Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The old 60-40 portfolio allocation model will be back from the dead in 2023. Joining me to discuss is Mary Ann Bartels, Chief Investment Strategist at Sanctuary Wealth, with her 2023 outlook. Mary Ann, it's great to have you with us. Welcome back to Trade Talks.
Thank you for having me.
You got it. And your overall thesis suggests 2023 could be the year of getting back to the bull. Give us a high-level overview of what you're thinking.
So for the equity markets, I think the bear is hiding in mega cap, high growth PE stocks. That's the bulk of it. But the bull is already running in the equity market, and no one is talking about it, which really surprises me. The bull is running in energy, industrials, and in the material sector, and also in healthcare. So I think what's happening is this very mega cap portion of the market that's weighing down the averages is masking the bull that's already running. So I think there's a bull there. And then I think as we go into 2023, as rates peak, we're going to have a phenomenal fixed income market. 60-40 is back. I mean, 60-40 has been dead for a long time. We haven't had really a bond market for people to invest in. And now you can even invest in cash. I mean, cash is now more than double the S&P 500 dividend yield. So I think there's a lot of great opportunity in 2023.
So the 60-40 model portfolio should, in theory, act better if you expect both bonds and equities to do well. It seems as if that's really the thesis behind it, and it wasn't working because equities were just kind of running at its own pace while fixed income really didn't have any performance at all.
Correct. Well, you had a bear market in bonds and a bear market in stocks, and that very rarely happens. So it's kind of like a double whammy here. And there was no way that we weren't going to have pain getting out of the zero bound policy. I mean, there had to be pain. But the good news is I think the pain is pretty much over. And, you know, when I look at the 10-year treasury yield, I wouldn't be surprised next year if you see it trading at a 2-handle. And I think you'll be able to get there fundamentally, and I think you're going to be able to get there technically. You know, as inflation peaks, rates are going to peak. Technically, the breakout is around 2.5%, so you should actually test that. But we're definitely in a new regime for interest rates. You know, going back to zero, I'm not so sure about, but 2-handle, I think that can happen, and I think that would surprise a lot of people.
Which, of course, is more reflective of the norm, too. Zero interest rate policy really, you can't really match that up with any other historical standards at the length of time that we were at such low rates. But it feels as if the market's almost fed up with the Fed, if you will, right? That you want to move away from the macro and start to think about those fundamentals more so than just being fixated on the Fed interest rate strategies and hikes and inflation. Do you think we might see that pivot to fundamentals next year?
I think that's a great point. And I think you bring that up, and I haven't really heard a lot of people bring that up. So I think it's an excellent point. It's really been a macro-driven year, and the equity market has very much been tied to the direction in interest rates, particularly the 10-year treasury yield. And that's normal, and it should be. What I've learned in my career is markets move with interest rates. You know, if interest rates are going down, you want to be in, in equities, long duration assets. Rates go up, you don't want to necessarily be in risky long duration assets, either in equities or fixed income. And I think the reason why people aren't pivoting yet to the fundamentals is that we've seen strategists on the street take down their numbers for the S&P 500, but we haven't seen the analysts really take their numbers down. And that's actually not uncommon. It's normally the strategists first and then the industry analysts, because they wait for the comments from their companies. So I think people are waiting for earnings numbers to come down. But as I'm sure you know, Jill, the market is a discounting mechanism. The market's going to be way ahead of the analysts actually taking down their numbers. And I think you can already see it by my earlier comments where the bull is already running in the commodity sensitive areas of the market.
Yeah, it seems as if a lot of people are really negative out there, though. So, to your point, it almost feels as if this capitulation point could be on the horizon because everyone is so negative. You get one positive surprise and then you're kind of off to the races.
Exactly. In fact, there's many people doing polls, sentiment polls of what people think 2023 will look like. And the consensus is the first half is going to be really bad. The second half is going to be really good. So I'm not betting on that scenario. I'm betting that markets can actually bottom in the first half, maybe even earlier than people think. And as I said, things are already working. But once we do bottom, some of this, high growth, high PE, the things that are down the most, the junkiest things, definitely rally the most off of a major bear market. But it doesn't mean that they stay leadership. So, coming out off of a bear, yeah, you want to own the junk, you want to own what's down just for performance purposes. But I really think the market has shifted from growth to value, and that value after that rally will take hold and actually lead the rest of the year.
All right, Marianne, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.